at GFI Group. He's with us today from the New York Stock Exchange. John, welcome back. It's good to see you again.
Hey, good to see you, Scott.
Like your headline today, there's a bubble in the market, but it's in pessimism.
Yeah.
People are still too negative, you think?
I think if there's a bubble in bonds, there has to be I think that's what we're looking at right today. And obviously, the employment cost index this morning put more power into the bond guys. So I think if you look at the government, actually wages increased there, so that's pretty funny. And meanwhile, the private sector cratered. So I think as we go forward, there's a shortage of quality assets in the world, right? So basically, people are looking for dollar assets, they're looking for bonds. You have Bunds this morning at 60 basis points. Swiss rates are negative again. Things are not that good in terms of what you could put your money into. So we have trillions of dollars of liquidity, right, that's just sloshing around doing nothing right now. But a lot of that money is going into, obviously, pension money has to go somewhere. They're buying a lot of bonds. We see a lot of, we want to talk about art, real estate, that kind of thing. That's dollar driven. But I think going forward, the interest rate differentials still favor dollar assets. We'll continue to see moves into equities. And the only way that the Fed is going to hike is basically the S&P going towards 2,200. If we stay at 2,100 or below, the Fed doesn't go in September. It's all about financial conditions. Financial conditions are stagnant. The only game in town right now are equities to drive the balance sheet of the individual investor and also the consumer.
Yeah, but I don't know why we should be so bullish, though. Equities may be the only game in town, relatively speaking, but we're just coming, we're going to come out of earnings season shortly, one that's been lackluster at best.
Well, if we take energy out, right, energy really cratered. The earnings are not that bad.
No, the revenues are bad. Revenues are bad.
Revenues, well, obviously, we could debate that, but I think the trajectory of earnings is up.
John,
the trajectory of earnings are up. We're not going into recession. Therefore, all the liquidity that's sitting on the sideline has to go somewhere, and that place that it's going to is eventually going to go into equities.
John, if we took banks and home builders out of the earnings problems in 2007, you actually had really good earnings for the overall market and great growth. The problem is you just can't do it. Energy is 10% of the S&P.
Okay.
But actually, John, I think energy earnings have been, on average, above the mean estimates. So they've added to it.
Above the estimates, but they've also obviously depressed the overall number.
76% of companies that have reported so far, up until yesterday, I believe, have beat the median estimate. Revenues, again, were they've been punked for the whole recovery.
Another aspect of this, Steve, is even those ones that have been sometimes beat on the second quarter, the guidance hasn't been all that good going forward. And frankly, not all, but most stock responses to earnings, good, bad, or otherwise, have been terrible this season.
Well, that's a good point. And I mean, look, they beat earnings slightly, but that's based on revised downward guidance. And going forward, the guidance has been revised downward even further. I mean, it looks not a rosy
picture here. Isn't that what markets always are? Markets always trade in expectations.
Of course they do.
You beat expectations, you go higher.
Maybe Spallanzani's right. Maybe, this rally that's been, for the most part, hated, one of the most hated ever, people are too.
I don't see how I don't see how.
I think we have a year or two left in the rally, basically. I don't see anything that's going to, unless we're talking about a black swan event or something like that, that money has to go somewhere. There's $1 trillion of corporate money that was refinanced up until July. $1 trillion of corporate QE. 55% of that corporate QE was in financials. $20 billion.
View, by the way, either. There's some a lot of smart investors who think there's a lot of runway left in the rally.
The AAII poll is,
or in the bull market.
It's a good organization, but I think the poll is outdated. It's 250,000 retail investors. We don't even know if they're in the market. So
and they only react based on what happened last week.
They react on what happened yesterday when the poll is.
But 41% are bears, so it's a bubble in pessimism.
We're 3% from an all-time high in the market. The balance of investor portfolios have never been higher in the equity category, whether you want to look at the Fed's own survey, you want to look at 401k balance surveys.
Have been, the mutual fund outflows have been outflow.
Have you seen the ETF outflows? Because they're not existing.
We trade ETFs all day, so yeah, I've seen the ETF flows. They're going into IWM, they're going into biotechs, and they're going into Qs.
So that's a bubble in pessimism?
So
they're going into tech and biotech, and we're saying that there's a bubble in pessimistic flows?
Wait a minute, you have to look at the flows.
There's a bubble in pessimism worldwide.
But
Come on,
you have to look at the flows into fixed You have to look at the flows into fixed income funds as well. I mean, they ebbed for a while, but they've been pretty healthy, amazingly so.
Is that where we want people into fixed income funds?
I'm sorry?
Do we want people into fixed income funds?
Bonnie does.
That's what I do.
I think we're beating on John way too much here. I mean,
I'm agreeing with him. I think Bill Mark's got 2 more years to go at least.
The flows into equity ETFs is exactly right. But what John is also right on is there's a lot of commentary about people hating the stock market. And look, what are the headlines that make news is when people say there's a bubble. So the data, Josh, you're absolutely right. The data does not support pessimism, but frankly, a lot of the commentary does.
Well, again, you're fighting the Fed and the rest of the central banks in the world. Russia just eased 50 basis points last night because of energy. India may go on Tuesday, another 50 basis points there. They just injected money into their banks. The Nifty rallied last night. So there are good stories, but nobody wants to tell them.
No,
I'm here to tell you the good stories.
People admit that there are good stories available around the world. They just question to whether the story's getting a little long in the tooth here because the Fed's about to move.
I don't think so, really. I think from
John,
what I
I'm
hear
with you on this, buddy. I'm with you.
From what I hear from the people on the street, nobody's telling me about stock tips. Nobody's telling me, I hear about Uber, that kind of thing. But in terms of the actual equity market, we're so far from a bubble. We're so far from a peak. Not only mentioning the fact that the earnings, the PE, on the whole, in the global sphere, is basically about 15. So I don't see any fraud anywhere in the world in terms of equity.
Wait a minute. I would say ignore what people are saying. Ignore commentary. Focus on what people are doing. They're shoveling money into Vanguard
and
passive investing funds like a coal furnace. They have never been more invested.
The numbers are telling me that we have nowhere else to go right now, given the valuations. Unless you're expecting deflation, then up.
We'll make that the last word.